Okay, so welcome to this session of the SBR. What I would try to do in the session of today is I would actually try to um, do the recent mock examination that has been uploaded by the ACCA. So that's what I would actually try to do. Um, that's what I would actually try to do. Now, my question to you: how many of you have attempted the mock examination? Yeah, how many of you have attempted the mock examination? Seems like nobody. Anyways, okay, Faith, thank you. And Faith, it's really good to see the way you have been submitting the assignments. It's really good to see that. Really happy to see the progress that you are showing while submitting the assignment. Yeah, basically, I was checking with Hadika yesterday and I realized that, mashallah, you have been submitting these assignments and it has been very pleasing to see that you have actually been doing it. So really, really happy to see all this. Um, anyways, now let's just start off. So what we could do now is that we could actually, uh, why is it not appearing? Why is it not appearing? Mock examination. Okay. So June 2024 mock examinations. I would actually go about starting this June 2024 mock examination, which has been published by the ACCA on their website. And what you could see is that obviously these are the initial pages where the instructions are given by the ACCA. And then as we move forward, we know that the actual examination comes in where we have got two questions from section A and two questions from section B. So that's what we have for the section A and for the section B. Now, let's move a bit forward and let's discuss further. So with respect to section A, it says the exam section is worth 50 marks in total. Now, what exactly are the things there? Let's just see. So we have got the first question, the name of which is Enrix Company. What does it say? Enrix Company is the parent company of a group which prepares the financial using IFRS. The financial year end is 31st December 7. And then it says that the following exhibits available on the left hand side of the screen are as follows. Now, what exactly are the requirements to the question? It says using exhibit number 1 and in accordance with IFRS accounting standards, explain with calculations how to correct the treatment of GAMBA in the consolidated financials for the year ended so and so, so and so. What I'll just do is that I'll just copy all these requirements. I opened the word processor document. So I opened the word processor document, and then now what we have is we have these things. Now see, um, so basically, let's just talk about it. The first thing is that let's talk about the acquisition thing. Let's just read through it. And if you could just read through it, then we could start discussing. Take 5 minutes, just start to go through it. Yeah, can you just go through it? Okay, now we actually talk about this and see what is actually happening. So it says on 1st January 2007, Enrix company acquired 60% of the equity share capital of Gamba company. The consideration transferred by Enrix was $50 million cash. Was $50 million cash. Enrix must also make further payment of 35 million on 31st December X8, but no accounting entries have been made. So there is actually a cash consideration plus a deferred consideration. There's a cash consideration plus there is a deferred consideration. So what you are actually gonna do is that when you're gonna open up this spreadsheet. So it has actually given you NRIC's consolidated statement of financial position and all that thing. So what you need to do is that you need to actually see that, okay, the key information which is actually part and parcel. So just try to note down the information, which is cost of investment, cash, 50 million, deferred consideration. We need to see how much is that. NRIC's company must also make further 35 million when on 31st December. So it should be like now the carrying amount of Gamba's net assets in its individual financial statement at the acquisition date was $80 million. Included in the net assets at acquisition was a factory building with a carrying amount of $10 million, a fair value of $40 million, and a remaining useful life of 15 years. So now see what happens is that for what date are we preparing? 31st December X7. This is 1st January X7. Now what are you actually going to do? Just try to understand this thing. So it's basically carrying amount of net assets is 80 million. Then what else is there? Included in net assets is a factory building with a carrying amount of so and so, so and so. Fair value, adjustment, factory building, which is actually gonna be 30 million. Now it says, and a remaining useful life of 15 years. Yeah, we don't have the discount rate till now. I'll just read through the question. I'm just trying to tell you that when you read through the question, just try to list down the information as you read through the question. Now it says that the tax base of the building is its carrying amount in the individual financial statement. The tax rate in the jurisdiction is 20%. Net assets have been included in draft consolidated at their carrying amounts. Taxable temporary difference is gonna be this 30 million. Deferred tax liability at 20% is gonna be this into 20% is 6. The net assets of Gamba have been included so and so. It's a group policy to measure the NCI at acquisition at its proportionate share. So it's a proportionate goodwill, it's not a full goodwill. Goodwill arising on the acquisition of Gamba company has been measured and recognized as 32 million. This was calculated as follows: cash consideration this, NCI this, carrying amount this, goodwill this, discount rate this. Now, present value of deferred consideration is gonna be this 35 because it is, I think, payable after 1 year, right? 31st December X8, payable after 2 years. So that's what the present value is gonna be. Now, if I try to calculate the goodwill, cost of investment is gonna be cash, deferred consideration, and then there is this total. So cash is going to be this. Deferred consideration is going to be this. So this is what it is going to be. Then non-controlling interest. Non-controlling interest. Fair value of net assets. So you have this building. Okay, we did not calculate the NCI here. So NCI is gonna be, how much was the NCI? 20% or 30%? How much? 40%. So hence resultingly, this is what the goodwill is gonna be. This is what the goodwill is gonna be. So this is what the goodwill should be. Do you understand this? Yeah, do you people understand this? Okay, now the question's requirement is that using exhibit number 1 and in accordance with the IFRS, explain with calculations how to correct the treatment of Gamba company. How to correct the treatment of Gamba company. Now, what are you actually gonna do? Let's just try to see this. So basically, see what did he do with respect to the accounting? He used the cash consideration, the deferred consideration. I'm just writing down here. The deferred consideration is to be included in the cost of investment at its present value. Fair value adjustment fair value adjustment relating to the building of 30 million is to be recognized while calculating the goodwill. The deferred tax liability on the fair value adjustments is required. The deferred tax liability on the fair value adjustments is required. Plus, additionally, what needs to be done is that the non-controlling interest to be established on the basis of revised fair value of net assets, the liability of the deferred consideration to be unwound, the liability of the deferred consideration to be unwound, and it is to be recognized as finance cost. The amount of expense shall be the revised carrying amount the revised carrying amount of the asset to be the excess depreciation on $30 million fair value adjustments is required to be made. The deferred tax liability the deferred tax liability would reduce due to the excess depreciation. The SOFP carrying amount of the net assets is to be adjusted to incorporate the SOFP carrying amount of the net asset is to be adjusted to incorporate the depreciation and deferred to incorporate fair value adjustment, depreciation and deferred tax liability. Yeah, is that okay? Now what you need to do is that there has to be the unwinding of discount also. Unwinding of discount is going to be this multiplied by 5%, 1.587302. How much was the additional life? 15 years. Excess depreciation is going to be this divided by 15 years. $2 million. The deferred tax liability will reduce due to excess depreciation by yeah, is that okay to all? Is that okay to all? Okay. Can you do this now? Can you do this now? The requirement is using Exhibit 2 and in accordance with IFRS explain with calculations how to correct the treatment of sales company in the consolidated financial statement. Yeah, please try doing this exhibit 2 now. Yeah, please try doing this exhibit number 2 now. Okay, now see. It says several years ago, Enrix purchased 75% of the equity share of Sal's company. On 31st December 7, Enrix sold 10% of the equity shares of Sal's company. So you sold 10% shareholding. This reduced its holding to 65%, but meant that control over Sal's company was retained. Cash proceeds of 22 million were received from the sale, with the other side of the accounting entry being recognized as other income in the consolidated statement of profit or loss. No other accounting entries have been recognized in respect of the share sales. Net assets of Sal's company in its individual financial statement at 31st December were carried at 146 million. On 31st December 7, Sal's company owned land which had a carrying amount in its individual financial statements of $6 million at the acquisition date, but a fair value of this. It is the group's policy to measure the NCI at the proportionate share. Okay, I've got one input. How about others? Abhi. Okay. See, now what happens is that you have only disposed of 10%. We gain or loss after incorporating fair value adjustment and take it directly to equity. Okay, so what actually happens is that on 31st December, you sold 10% of the equity shares of Sal's. This reduced its holding to 65%, but meant that control was retained. Um, Cash proceeds of 22 were received from the sale, with the other side of the accounting entry being recognized as other income. So you just said cash debit and other income credit in the P&L. No other accounting entries have been recognized. Net assets were carried at 146 million. Sales owned land which had a carrying amount in its individual financials of 6 million at the acquisition date, but a fair value of 18 million. The group policy is to measure NCI at its proportionate share of the fair value of the identifiable net assets. So what actually happens is that in this specific scenario, exhibit 2, what would happen is that disposal proceeds 22 million, carrying amount of subsidiary net assets, carrying amount is going to be this 146 million, 146 million. Fair value adjustment is equivalent to 12 minus 6, 18 minus 6, hence 12. So basically what happens is that this is what it is. Now, percentage disposed is 10%. Hence, resultingly, this into 10%. Right? So this is going to be this minus this gain on disposal. Now, if this is a gain on disposal, then what is going to happen is that the correcting entry should be like this. Other component of equity slash retained earning is debited. Is credited by 6.2. The profit and loss account is debited by 6.2, is debited by 22. Non-controlling interest is credited by 15.8. Gain should not be gain on disposal to be recognized. Gain on disposal to be recognized within equity. The carrying amount of the net assets was 158 million, of which 10% was disposed, resulting in a transfer of $15.8 to the NCI. The gain on disposal of 6.2 million to be recognized within the equity. The gain on disposal of 6.2 million to be recognized within the equity. Okay. Now the last requirement is he has given you draft SOFP. The requirement of the question was using so and so adjust pre-populated spreadsheet response to correct the draft consolidated SOFP. Now, can you give it a try? I'll just open this in front of you so that you actually have. Yeah. Can you just look at and see that what exactly can be done on this? Okay. Now, so if I try to incorporate the adjustments, the adjustment is going to be with respect to the property, plant, equipment. There would be adjustment of 30 minus the excess depreciation plus minus this excess depreciation of 2. In fact, I have already deducted the excess depreciation. The goodwill was shown as 123. Whereas the goodwill was recorded as nil over here, or 2. So equals to, then what actually happens is that the current assets is gonna be the same. Share capital is gonna be the same. Other components of equity, we have to have an adjustment to the other components of equity. How much is the adjustment going to be? For the retained earnings, this is given. Minus this, minus this, plus this, minus then the non-controlling interest is going to be 41.6 minus what was originally there, 32, minus 32. So 41.6 minus 32. $41.6 minus 32, because the NCI needs to be adjusted by this amount, plus this 15.8, and then minus or plus, bracket open, 40% multiply by, bracket open, there was an excess depreciation, plus there is this reduction in deferred tax liability. So hence this plus this is what we have. Now for the non-current liabilities, the deferred tax liability is increasing by this and reducing by this. For the current liabilities, I don't think there is to be any adjustment. Yes. In fact, this was the present value of deferred consideration plus this unwinding of discount. It is 1119. 1119.76, and here it is 1132.346. So 12.64 is where we have a difference. Is it justified by something? Okay. How many of you tried to balance the balance sheet? How many of you tried to balance the balance sheet? And what is the answer that you got? It's okay. Even if you show them as a net, that is okay because you see the formulas are being shown. So they can see the formula because the spreadsheet is being shared with them, right? So they can see the formula. So not an issue. Okay. So we have actually completed this. It's okay even if it does not balance completely. We might have made some error, but at least we got it through. Now let's move a bit forward and let's talk about the next question, the name of which is refer company. The name of which is refer company. Okay, so next is Refer Company, the health and pharmaceutical company, which prepares the financial statements using IFRS. The financial year end is 31st December 7. The following exhibits available on the left hand side of the screen are as follows. Now, the requirements are that using exhibits 1, discuss the ethical issues raised by Mr. Chan's profit maximization targets. That's requirement number 1, which is you have to discuss the ethical issue because of this specific thing. Now, what next? Can you just look at this exhibit number 1? Can you just look at this exhibit number 1 and see? Can you identify it's a 10-mark requirement? Can you identify the issues? Can you identify the problems? Yeah, can you identify the problems? Yeah, it's a 10-mark requirement, so you have to try and identify 10 issues in this. Okay, let's just see. So now see what happens is that when we try to look at this ethical scenarios, it says refer company. Okay, now so it says refer company, the health and pharma company, which enjoys a significant brand recognition and trust. A new finance director and ACCA member has been appointed, and his target is maximizing profit. Okay, so finance director tasked with finance director tasked with finance director tasked with the maximization of profits would make him biased. This is a clear self-interest threat. The production Now, production director Miss Finch has told that there is a safety issue with the security seals on one of the medicines that refer company sells. The cost of recalling would be $1 million. Miss Finch has planned to recall the medicine, but the finance director, Mr. Chen, has blocked the plan as he feels that it will affect the share price of the company. As he feels that it will affect the share price of the company. Now, so what happens is that he has blocked the plans to recall the medicine. His viewpoint is that there is a very low risk to the public. Chen suggested to the board if they wish to recall the medicine, they should buy it back using a third party in order to hide the issue and protect the company's reputation. So basically, lack of integrity, lack of professional competence and due care. There's a lack of integrity plus there's a lack of professional competence and due care. Personal interest is dominating and is compromising health and safety of greater audience. Then it says Chen has also instigated a cost-cutting program which will affect several medicines which are due to enter market over the next few years. Chen receives bonus of 1% of net profit. Now, the cost cutting is appropriate as long as the efficacy, effectiveness, and quality of the product is not compromised. Now what next is there? Chen has decided that rather than invest in R&D, which may never be approved, refer companies should acquire companies currently holding medicine patents. Principle behind this move is having bought these companies, refer could hold the patients and raise the prices of the medicine significantly. Now this is basically healthcare should not be exploited. Earning exorbitant profits, and that too from the life-saving drugs, is lack of due care and is unnecessary burdening the public. Um, Refer company would overcharge for medicine in order to increase profit by manipulating market prices, hopes that refer company may grow significantly if there is limited competition in the farm. Can you think of any other pointers from this? Yeah, can you think of any other pointers from this? Can you think of other pointers, please? Faith, have I missed out any of the pointers? Company's reputation at stake. Okay, did he ask for the action? Did he ask for the actions? Yeah, did he ask for the actions? No, na. So I don't think that we need to actually do that. Yeah, but when you are gonna elaborate it, so you're gonna actually get the 10 marks. Don't worry about it. Can you just go through this? The requirement is that explain how the sale of medicines to the foreign government should be accounted for in the financial statement for the year ended 31st December 7. Now the word processor requirement is like this. So can you just do it? Can you just do it? Yeah, can you just do it? The requirement is that how the sale of medicines to the foreign government, including outstanding receivables, should be accounted for in the financial statements. Should be accounted for in the financial statement. ले रहा हूँ क्लास ले, काम दिया हुआ। आप बताओ, मेरा से लिया ग्रीन खपे हैं क्यों कलर नहीं, लाइट पे रहूंगी। बाद शाम। Okay, now let's just see how the accounting is gonna be done. Okay, Faith has answers. Okay, let's just see. Refer company sells medicines to a government in a different jurisdiction, but has experienced significant delay in receiving payment. So you got to recognize the impairment. Currently, it has outstanding receivables of 3 million, with some of the amounts being 4 years overdue. However, referers continue to sell medicine to the government at its normal market price. These medicines are essential in fighting the diseases in that country. Refer company attempted to renegotiate the payment terms and stated that they would accept consideration below the contract price, a price concession. By 31st December 2007, no agreement had been reached. Both parties accept that the refer has an unconditional right to receive the payment. Okay. So basically what happens is that there are a few things that you need to do with respect to it. First of all, if you are talking about the refer company, if you are talking about the refer company, the outstanding receivables that are overdue requires the outstanding receivables that are overdue requires a provision for the impairment loss to be recognized. Additionally, the amount repayment that is likely to be received should be considered, and a bad debt expense, which is the impairment of financial asset under IFRS 9, is to be recognized. Under IFRS 9 is to be recognized. For the future sales that are made, an assessment should be made of whether the consideration is recoverable or not from the then revenue shall not be recognized. Abhay. In case if the consideration is probable that it will be received, then the revenue shall be recognized on the basis of present value, considering the normal time period needed to recover the money from the government. Unconditional right to payment is basically a receivable. The unconditional right to payment means that you should be recognizing the receivable. Unconditional right to payment means that it is a receivable. I think two of us are the active, the rest are not active. Rest are just absorbing what we are just doing. Anyways, so we are done with this question number 2 also. Now let's just try to do the question number 3. Let's try to see. Jared company prepares the statements in accordance with IFRS. The financial year end is 31st March. The requirements, what are they? In fact, what I would do is that I would just take a short break of 10 minutes before I start off. So I'll just give you a short break. Okay. Now let's just start off. It says using exhibit number 1 in accordance with IFRS 16 leases why the server contract contains a lease and explain with calculations how to measure the carrying amount of the right of use of the asset and the corresponding lease liability in the financial statement of Jared Company as at 31st March 2013. So this is what it is actually all about. Let's try to understand this. Explain in accordance with IFRS 16 and explain with calculations how to measure this, etc., etc. Let's try to see this. So can you just come on to this server contract thing? Can you just look at it? There are two questions to it, whether why the server contains a lease and explain with calculations whether the carrying amount, how to measure the carrying amount. Can you just go through it 3-5 minutes? Then we could start discussing. Okay, it says on 1st April, Jared company entered into a 5-year contract with Serviso for digital services. Under the agreement, Serviso installed a hardware-based server, a physical device which manages the accesses in computer network at Jared's head office for the duration of the contract. Server is explicitly identified in the contract. The server is explicitly identified in the contract. The server is explicitly identified in the contract. Just a second. Huh? The server is explicitly identified in the contract, and Serviso can only change the server if it stops working. Direct company controls the data which is stored on the server and has integrated the server into its operations. Servico maintains the server and provides data backup and software upgrades. Servico cannot determine how the server is used during the term of the contract, nor it can decide whether to modify the server for use it for another purposes. Now see, first of all, why the server contract contains a lease. A lease is a contract in which lessor allows the right to use the asset to lessee in exchange for a consideration. For the lease to exist, there must be an asset which is subject to the lease. For the lease to exist, there must be an asset which is subject to the lease. So there must actually be an asset which is subject to the lease. There must be an asset which must be subject to the lease. The asset is under the control of Jardin and is explicitly identified in the contract. It is the Jared company, I'm sorry, not the Jordan, Jared company which decides how the server machine is to be used, and hence it is the Jared company that actually decides that how the server machine is to be used. Just a second. Okay. Decides how the server machine is to be used, and hence Servico only has the right to exchange the machine just in case if it goes into a error/problem. Therefore, on the basis of this, there exists a lease agreement between Servico and Jared Company. Second, it says explain with calculations how to measure the carrying amount of the right of use of the asset and the corresponding lease liability. There are 5 annual payments to be paid under the contract of $1.05 million in advance beginning on 1st April 12. Jared Company will receive cashback of $525,000 on the first anniversary of the contract. There were direct legal costs of $100,000 paid by Jared Company. Fair value of the server is $5 million on 1st April 12 and the interest rate implicit in the lease is this. Useful life of the server is 5 years. There is no residual value, no option to purchase the server at the end of the contract. Legal title remains with Servico throughout the period of the contract. Jared pays for insurance and maintenance of the server separately from the annual payments. The cumulative present value is so and so, so and so. Let's try to do the calculations and see. Calculations for the lease. Calculations for the lease. So what would actually happen is that timing of payments, 0, 1, 2, 3, 4. So the timings are actually like this, 1.05 million, right? And for year 1, there is a payback, cashback of 525,000. So I've incorporated the cashback of 525,000 also. The discount rate is 5%. The present value is gonna be this into this. So resultingly, what happens is that this is what it is. Now the combined present value turns out to be what? 4273428. Now what would happen is that you would say that the present value of lease payment is this. The fair value is this. The fair value is this. The fair value is this. Now what actually happens is that So basically what happens is that the right of use of the asset should be recognized at the lower of these two, which is this. Then what else is going to be there? 1st April. We are talking about the year end of 31st March 3. 5% is the rate, right? So accounting for the liability, 1st April X2. This is what it is. 1st April X2. The repayment amount is this. The balance copy again, paste here. So 1st April X2, this is actually going to be this plus this. Then the finance cost at the rate of 5%. March X3. At 1st April X3, repayment is gonna be cashback is going to be 525,000. Hence, yes, sure, Faith, sure. Now, so 1st April 2, that's what we had now. Plus, then what actually happens is that at 31st March X3, we had this again. On 1st April, there was a repayment and then the cashback. So the revised liability is this. Now, for the ROU of asset, cost will be this plus how much was that? It was 100,000. It was 100,000. Depreciation is going to be this divided by 5. Carrying amount at 31st March X3 is gonna be this plus this gives you this. Now, so basically what is actually happening is that this is how you are gonna account for it. Now I can actually say that what would be the accounting? The accounting, again, I'm writing down the bullet pointers, but from the perspective of the examination, it's not the bullet pointers that you have to write. From the perspective of the examination, it's actually the short paragraphs that you have to write. Okay, the accounting for the leased asset shall be as under. The initial carrying amount of the asset the cost of the right of use of the asset shall be the present value of lease payments plus the initial direct cost. The lease payments after incorporating the impact of the lease payments after incorporating the impact of the lease payments after incorporating the impact of the discounting and the cashback are so and so, so and so, so and so. The advance rentals lead to reduction in the liability at 1st April 2000X2. The right of use of the asset is depreciated over 5 years on a straight line basis. on a straight line basis. The carrying amount of the liability the carrying out of the liability shall be so and so so and so. The liability shall be split into the current and the non-current portion. Current portion shall be so and so so and so. Non-current portion shall be so and so so and so. The right of use of the asset shall be recognized at so and so so and so so and so. So you would incorporate all this. Now let's just come to part B. The requirement of part B is that discuss why the reasons why cryptocurrency may not meet the definition of cash or cash equivalent, but may meet the definition of an intangible assets. So there is no need to refer to a specific exhibit. So basically what happens is that this is one of those questions that has been examined in the past also. And there is a technical article on this area also. So basically what happens is that cryptos are based on the distributed ledger technology. There is a lot of variability in their value. They do not meet the definition of cash and cash equivalent, as they may not be a legal tender in many countries. So they do not meet the definition of cash, and as they may not be a legal tender in many countries. Plus, the value of the cash is not fluctuating. Plus, the value of the cash is not fluctuating. Additionally, additionally, what you need to understand is that they do not create a right to receive cash unless sold. Hence, they are not financial assets. The definition of intangible suggests that intangibles are identifiable, non-monetary, not cash, not a right to receive cash, assets. And for anything to be termed as asset, entity must be able to control it. Without any physical substance. Cryptos exist digitally. Based on all these, based on all these, based on all these, the cryptos are closest to being categorized as the intangibles and not the financial assets. So this is what it is all about. This is what it is all about. Lastly, using exhibit number 2, discuss the steps that Jared company should take to measure the fair value of the cryptocurrency in accordance with so and so. Briefly explain the impact on the financial statement. Using exhibit 2, discuss the steps that Jared company should take to measure the fair value of the cryptocurrencies in accordance with IFRS 13 fair value measurement. Now, uh, can you go through this, please? Yeah, can you go through them, please? Hmm. Okay, let's see. The directors of Jared believe that measurement guidance in IFRS accounting is standard, does does not provide does not provide. Hmm, hmm. The directors of Jared believes that measurement guidance in IFRS does not provide relevant advice on cryptocurrency valuation to help them prepare their financial statements after consulting the external auditors. Directors intend to account for the company's holding using revaluation model in IAS 38 intangibles because auditors do not believe that crypto meets the definition, so and so. On 1st January, Jared purchased 1,000 units of cryptocurrency for $6,500 per unit. Cryptocurrency is traded in several markets with different prices being quoted in each market, as there is no single price for the crypto. Jared cannot access every market as some markets have restriction which affect the trading. The markets are volatile and they trade 24 hours a day. Market size, transactions per day, price per unit at close of business. Market A allows trading for values less than $10,000. 1,000 units, each unit was of 6,500. Market B, trading in crypto needs a license which can only be obtained by financial institution. That means market B is out. Trading in the currency is on the derivative market and is not subject to specific regulation. And trading in the crypto is on the derivative market and is not subject to specific regulation. Although there is no direct ban on the trading of crypto, there are very strict rules which make trading very difficult process. Now see what happens is that in order to measure the fair value, the most active market is to be identified. There are most advantageous markets and then there are most active markets. Most advantageous, most active market, which are also termed as the principal market. The most advantageous market is where the highest value could be obtained, but the principal market is where highest volumes are traded. The principal markets are where the highest volumes are traded. The principal markets are where the highest volumes are traded. So in the current case, in the current situation, market E is the most advantageous market as Jared can fetch USD 7,560 for each of the crypto unit. However, for each of the crypto unit, however, this is not the principal market as the traded volumes are low and the restrictions on the trading are high. Traded volumes are low and the restrictions on the trading are high. Now what next is going to be there? So you have got this. A allows trading for values less than 10,000, but they're very low volume. Then market B, market size is $200 million. Trading in crypto needs. Now, A is not relevant as very low volumes and trading size is also very low. Jared is not a financial institution, therefore cannot trade in B. C, value of 6300 can be obtained and the traded volumes are high. D, conditions similar to C, but it is even higher volumes than C. So basically what happens is that the fair value shall be ascertained on the basis of the market D, and hence the fair value of the cryptos for the purposes of revaluation under for the purposes of revaluation under IS 38 shall be for the purposes of IS 38 shall be 6350 per unit. Shall be 6350 per unit, and that would lead to a loss of $150 per unit. Total loss would be the total loss would be 1000 multiplied by 150 is equivalent to 1000 multiplied by 150 is equivalent to how much? $150,000. So you see there are markets which are advantageous, but you have to always use the fair value on the basis of principal market. On the basis of principal market. Hmm. Yeah, is that okay? Yeah, hello. Are you people getting it? Why are you people sleeping? Why is everyone sleeping? Is it helping you people out? Yeah, everyone. It's just that except for Faith, nobody is responsive. In fact, there was just Monmouth who actually had contributed once. How about others? Okay, lovely. So see, we have been able to do this mock to the maximum extent. Now, what I want you people to do is that you all are in the WhatsApp group. I want you people to actually just keep on asking the questions from the different topics that you have. I'll keep on responding back. Plus, in addition to this, just practice as many past paper questions as you can from the learning from the CB practice platform of the ACCA. Because you see, the more you are actually gonna do, the better it is going to be for you. The more you're gonna do, the better it is going to be for you. Right? Okay. So what I'll do is that I'll just keep it till here. And what I am expecting you people to do is that to go about discussing, go about practicing the past paper questions to whatever extent that is possible, right? Yes, I will try because you see, if I'm going to be extracting from here, I don't know to what extent you will be able to see the Excel workings that I did. But yes, Word obviously you can actually see. Yes, the recordings would also be there. Don't worry. Right? Okay. So thank you guys. Thank you for being there. See you all inshallah very soon and wish you all the best.